Good morning, everyone, or good afternoon, good day. My name is Nicholas Peile, and today I will be taking you through the world of cryptocurrencies, this idea of a decentralized monetary system. And today in this presentation, I will be taking you through a brief history of Bitcoin specifically, talking about what is a cryptocurrency, looking at how Bitcoin works, such as blockchain technology, the process of mining and the energy costs, and then focusing on the rise of Bitcoin and popularity. Then after that, we'll then take a bit of a detour into the world of Ethereum, which is known at this moment as the Bitcoin alternative, taking a brief look at the history of that and the introduction of the proof of stake system. And then we're going to be looking at the world's response to cryptocurrencies, such as who is embracing crypto versus who is restricting it. And also, of course, taking a closer look as to how crypto is being handled in South Africa, before finally we're going to be looking at the question of, is the future crypto? Can crypto be used as an ETF? Can it be used as an investment vehicle? And then finally, are we currently running the risk of being in a crypto bubble? So, going forward, let's take a brief look into the history of digital currencies. Now, although Bitcoin started making waves back in 2013, the idea of a digital currency is not as new as you might believe. Usually when we think about money, we think of two types. There is the claim to money, which is the money that we have in our bank accounts. And then there is money as an object, which is typically the physical hard cash. It is the unit of account of the economy. But what happens if suddenly you have an object, you want a form of objective money that isn't linked to any one singular economy, that is currently completely decentralized from it all. And so that is what the idea of cryptocurrency is, a decentralized currency separate from any economy, separate from any central bank. So the first person to actually propose this idea was all the way back in 1983 by a man named David Strom, who proposed this idea of an anonymous electronic cryptographic payment system. What this meant is that he wanted to limit the data and information gathering by third parties. If a transaction was to occur, the only people who would be aware of it would be the payer and the payee. And while money is transferring, banks only approve of the idea of the transaction. What this means is that they know that a transaction is taking place, but they don't know the amount, they don't know who it's going to, and they don't know who it's coming from. And of course, the payer and the payee are the ones who then receive the receipts for these transactions to actually confirm the final location and to also be used in case there's any question of fraud or theft. Now, Strom then founded DigiCash in 1990, trying to use this system, with the first transaction taking place 4 years later. And at the time, he managed to get 5,000 customers and 300 merchants to sign off on it. And initially, this system did gain some attention from organizations such as the Mark Twain Bank, Deutsche Bank, and Credit Suisse. But unfortunately, it failed to gain more traction over time, and so eventually filed for bankruptcy in 1998, 4 years after the first transaction. But while DigiCash may have failed, the idea was still there. And as a result, numerous other encrypted electronic currencies had been proposed over the years. For example, Hashcash introduced this idea of you have to solve this computational puzzle using a process known as proof of work, which effectively, for any transaction to go through or for any file to be sent, anything being sent from one person to another, you first have to generate a certain value that meets a certain criteria. And only once that criteria has been met, which is typically you have to generate a value that is equal to or below a target value, only then will anything be sent through from person A to person B. B-Money proposed the idea of a decentralized ledger, meaning that all participants and all people will have access to a ledger of all transactions happening between people. And finally, in 1998, Nick Szabo founded BitGold, or at least proposed the idea of BitGold, in which he utilized these proof-of-work mechanisms in order to verify data chains, and that could be used to mine digital gold. Of course, the computers would be used to solve these cryptographic puzzles, and the solutions would then be verified in these tamper-proof public ledgers. However, as I said, this was all theoretical at the time, due to technical limitations of the 1990s. Now, why did I highlight these three in particular? Well, that's because these are what the foundations of the modern cryptocurrency is built upon. It is built upon a decentralized ledger, meaning that there is a digital record of all transactions that are kept in order to maintain the information, which these transactions are then verified by miners and that everybody has access to. It is a decentralized database, meaning that no blockchain or there is no central database, no single authority over this network, and there is no intermediary where cash has to first flow through. And then finally, it employs cryptographic technology, meaning that there are these cryptographic methods that are used in lieu of a governing authority in order to verify and secure transactions. And as I've said, even though the idea of cryptocurrencies started way back in the 1980s, really it's only been in the past decade that crypto assets have been increasing in popularity and in value, with a sudden rise back in 2017, which suddenly resulted in a dip, before suddenly exponentially increasing in value in 2021 during the pandemic. But as you can see from this graph on the left, out of all of the crypto assets currently on offer, there has always been one that has dominated, which brings us to Bitcoin. So, what is Bitcoin? Well, the technical definition is that it is a decentralized cryptocurrency developed on this idea of a free market currency for peer-to-peer payments without the need of this financial institution medium. However, that is quite technical and not very clear, so let me portray it as this. Imagine that you have if somebody were to ask you, what is a crypto coin? If I were to have a crypto coin physically in front of me, what would it be? I want you to imagine a clear box, a box that anybody can, with the right software, look into and gain access to it, or at least just to inspect it. And inside of that box is a list of people. And on that list of people are everybody who has previously owned that box. And of course, you can't use this box for typically whatever you would use a box for, such as storing content, but that box has value, and you can trade the rights to that box to another person at a certain agreed upon price. At the end of the day, that is what a Bitcoin is. It is an object which anybody can see who owns, and anybody can see the record of, that has value and can be divided even further into parts. And so the idea of Bitcoin was first introduced in 2008 by a man named Satoshi Nakamoto, or at least that's what we believe. The problem is that we have no idea who Satoshi Nakamoto is. The name is a pseudonym. To this day, we still have no idea who he is. And so Bitcoin was finally launched in 2009. So how exactly did Bitcoin differ from all other cryptocurrencies that we have seen previously? Well, the main explanation for that was that it worked. You see, back in 2010, the first Bitcoin transaction took place when somebody bought 2 pizzas for the low price of 10,000 Bitcoin. In today's value, that is worth $921 million. Just a few months ago, when Bitcoin was at its peak, that was a value of $1.1 billion. And so we can see on this graph on the top left is that Bitcoin has also experienced very large, rapid rises in values, starting in 2017 before dipping in 2018, then suddenly in 2021 during the pandemic, again decreasing in 2022, before last year where it suddenly increased in value and doubled its price in a short amount of time. We're reaching a peak of about $120,000, but right now it currently sits at, as of right now, which is December of 2025, it is sitting at closer to $92,000. And so what's interesting to note is that Bitcoin itself is limited. There is in total only 21 million coins that can ever be in circulation, with currently 19.9 million having been mined so far, with the last coin expected to be mined in 2140. How does this work? We'll get there. So how exactly does Bitcoin work? How does these transactions take place? What makes it so impressive? Well, for that, we need to now look at blockchain technology, a term that you have probably heard in parallel to Bitcoin and cryptocurrencies as a whole. So what is blockchain? Well, blockchain is that decentralized ledger. It contains the history of all of the transactions, and it is contained by different nodes. What is a node? Well, a node is the device that within the blockchain network that validates the transactions and maintains the security. If you have a computer or you have a phone that uses cryptocurrencies in any way, that trades on a blockchain network, then you are a node. That is why there is no central database. Every computer and every electronic that participates in blockchain and participates in crypto transactions is the database. Of course, each person will have a private and a public key. These are effectively your identifiers. Your public key is the address that your crypto is sent to. It is effectively your bank account number, if you want to think about it that way. And then there is the private key, which is something that only you know. It is effectively your password to your crypto account, and that is what you use to sign any transactions to go through and to encrypt any data before it is sent out. And so effectively, a blockchain is this chain of blocks. Now, if we actually take a look at how this block is actually structured, for any transaction to first occur, first a number of pending transactions will be put into one block from the overall mempool, as it's referred to. And so that is the first part. But the other is the block header. And it's this block header that contains all of the information of the blockchain technology so far and contains the ledger. Of course, there is the Merkle tree, which is that history. There is the n bits, which is this target threshold, as we talked about with proof of work. And of course, there is the parent block hash, which is just the preceding block that the current block would be attached to. But why this is so important is its use of hash technology. This is the crypto part of cryptocurrencies. This is the cryptographic method. But you see, how this works is that in order to maintain block integrity and the security, this block header first goes through a cryptographic system in which your input generates a random output. And as we can see from just this bottom of the text here, there is just for example, if we changed Sygnia to Sygnia, just a small little change of two letters swapped around, you can get vastly different outputs. These hash systems and crypto systems are incredibly sensitive. And as a result of this, you cannot control your output. You don't know what you are going to get from what you put in. It is completely random. And that is why people say that it is secure, because it prevents gaming the system. It prevents you from just putting in the same value again and again and getting all the value for itself. So, and that, of course, takes us to the next section. which is Bitcoin mining. What exactly is mining? Well, this is the process of approving these transactions. You see, you might be wondering why would you even want to be a Bitcoin miner? Because Bitcoin mining is how you actually get awarded with Bitcoins. Earlier, I mentioned that there is a hash value that is generated, but then also before that, I talked about proof of work, the fact that you have to reach a target hash, generating a value either equal to or less than a certain threshold. Only then will things be approved. And as we can see here, typically the system that Bitcoin uses is 64 digits long, with 16 possibilities for each character, giving us a total of 115 quattuorvigintillion different possibilities of what can be generated in hash values. This is an incredibly high number. It's honestly quite difficult to even think about or to put into terms that can give you the equivalent sense of scale. It is massive. And so, because Bitcoin has a certain difficulty to it and can adjust its difficulty, if the first certain a number of these characters are all 0, this will keep the target hash very small, and as a result makes it even more difficult to find a valid hash value to then append and approve of this transactions. This is what happens in proof of work. You are effectively churning out these random inputs to get these random outputs for the small possibility that you will reach that target threshold. And if you are the first person for each block, because each awaiting block has a target threshold, if you are the first person to reach that threshold, you are then awarded with Bitcoin. That is Bitcoin mining. And so, after this correct value is then awarded, as I mentioned, Bitcoin is awarded, but in order to make sure that there's not suddenly this rapid increase of Bitcoin supply entering the market, the value of Bitcoin awarded is actually halved every 210,000 blocks that are amended. So back in 2009, successful validation would result in 50 Bitcoin. Today, it is only 3.125. But of course, this isn't the end of the process, because even if all the other nodes weren't the initial one to get the right value, all the other nodes have to then also inspect the block, and to make sure that the contents of the block match what the block header says to approve the transaction. And why this is important is that you need to have at least 51% of all of these nodes and all of these miners confirming that the block header matches the contents for any of the transactions to go through, for this block to then be appended. This is why it is known as a consensus algorithm. Of course, if you are just one of the validators and you're not the initial validator, you are not awarded with Bitcoin. And so we can see on this, apologies for that very lengthy description, but as we can see from this graph on the left, in just a few years, the total hash rate of the entire network system has almost increased by 5-fold. That just gives you a sense of the scale of how many hashes are being generated at one time, and also to give you an idea of just how much competition you are working against. And so, if you're wondering to yourself, well, I might have a laptop in front of me right now, why don't I just start using it to mine Bitcoin? Well, the problem is that in order to be generating these hashes again and again and again and again and again, that of course requires electricity, which can range from a total of 12 to 42 joules per second. And so, if we actually look at the total electricity used in the entire Bitcoin network, just the Bitcoin network, that is currently at about 181 terawatts. To give you an idea of this, the total amount of energy that South Africa produced back in 2024 was 224 terawatts. So the total energy consumed by the Bitcoin network is 3/4 of what South Africa was able to produce last year. And so the average cost of mining a Bitcoin is just over 1 million rand, which with its current value at about 1.5 million rand, you are typically looking at about 53% return on investment. Of course, this is highly variable depending on energy costs in your home country. And so in South Africa, the cost of mining a Bitcoin is more closer to around 300,000 rand, so a 440% return on investment. But of course, your chance of a successful transaction decreases with scale of competition. And so, as Bitcoin's appeal has increased, more and more energy has been demanded in the process of mining. And this has primarily been dominated by the United States and by China, with the US currently has the world's share of about 38% of all hash rates in the world is coming from the United States. And in China, 1/5 of all of the world's hashes are currently happening over there, with the largest mining pool being by a company called Foundry USA. They are hashing at a rate of 336 exahashes, which is the equivalent of 336 quintillion hashes per second. That is what you are up against. And as you can see, as I said, as a result, there has been a very large increase in total energy that has been consumed as a result. And so might be wondering to yourself, well, if the cost of mining Bitcoin is so high, or depending on your region, and from the sounds of it, the total amount of Bitcoin that you are receiving may actually be decreasing every 4 years, and the entire network is purely reliant on this process of mining, well, what happens if the marginal costs are greater than the marginal benefits? What if the cost of electricity is higher than the Bitcoin received? Well, that is why a new consensus algorithm was introduced and has been proposed. And this is known as proof of stake, where instead of being a potential validator, instead of going through this process of mining, what instead you're doing is that for each pending transaction, you can put in a little bit of money or a little bit of cryptocurrency. And so effectively, you are then staking your crypto, because if you are putting money in, you are then have the possibility of being chosen to be the initial validator. So of course, the more money that you put in, the higher your increase. You get a probability based off of your share. And so more staked, higher chance. And so all validators, even if you aren't chosen, have to then attest that block is accurate and thus confirms the hash. And so as a result of this, you currently don't have these multiple millions of calculations going on at one time, all in this off chance that you suddenly generate this perfect value that meets the criteria. Instead, it is purely a gamble, even more so. And so while Bitcoin itself does not use proof of stake, it has been adopted by Ethereum, by Solana, by Binance Coin, and each of these companies and these cryptos do take a little bit of pride in saying that the amount of energy that they consume is much, much less than what Bitcoin does. And so, if we actually take a look at how Bitcoin has done and why it's suddenly increased in value, well, it's been increasing over the past 8 years. It had been increasing in those initial 8 years very slowly before suddenly skyrocketing in 2016. It went to 443. A year later, it was at 1,000. A year after that, it was at 15,000. Very quick increases in value. Before, they then experienced prices dropping in large sell-offs. But then last year, 2024, in November, it it currently then experienced a sudden rally as a result of President Donald Trump winning the 2024 US elections, considering that he is much more accepting of Bitcoin and cryptocurrencies than previous presidents. And so we'll get into that a bit further. And so in a short amount, back in 2024, Bitcoin more than doubled in value from 42,000 to 98,000. And so this Bitcoin confidence was spurred on with more approval of Bitcoin ETFs, specifically in the US market, Trump promising to create a strategic Bitcoin reserve and to introduce more crypto-friendly policies, and also by a sudden increase in large-scale Bitcoin purchases by corporations such as MicroStrategy, Tesla, and Trump Media. But if we just look at these graphs on the left, we can see that the adoption of cryptocurrencies by upper middle income countries and high income countries is actually still very recent, because for a significant amount of time it was low income countries who were the primary adopters of Bitcoin. It was only last year where suddenly these wealthier countries were saying, hey, there is actually some value in Bitcoin. There may be some validity. So we should start looking at Bitcoin more seriously. And as a result, Bitcoin had been gaining more legitimacy. And if we just take a look at these bar graphs on the bottom, where we actually look at how cryptocurrencies have worked in South Africa, for a significant amount of time, Bitcoin was the largest cryptocurrency being traded in South Africa. But then quite recently, in the past year and a bit, that has been substituted by stablecoins instead. And we'll talk more about why that is in a bit. And so why has crypto been so appealing in all of this? Why is suddenly crypto as an investment becoming more and more viable? Is it just due to its value? Not necessarily. Because it is a currency that is not tied to any government or central bank, that makes it a very alluring alternative during periods of economic uncertainty or periods where there is strict capital control. This is especially so in countries in which there is non-independent central banks who are worried about any currency manipulation that may be introduced by their governments, and any also political use of monetary policy. Because suddenly, if you are worried that your money might lose value internationally, well, suddenly here is this other alternative currency that isn't losing value as much, and suddenly this is also something that a central bank can't stop you from accessing, can't stop you from trading. Furthermore, the belief in expansion of blockchain technology in and of itself has created more opportunities, and as a result has been increasing the appeal of crypto as a method of exchange. But if we actually take a look at this table on the left, if we go back to looking at who has been the adopters of cryptocurrencies, the primary ones who have been taking it on have been countries like India, Nigeria, Indonesia, Ukraine and Russia, the Philippines, Pakistan, Brazil. These are not wealthy countries. These are not your United States. These aren't countries like Europe or countries in Europe. These are much poorer countries that are seeing appeal in cryptocurrencies as an alternative to their local ones. And over time, this total limited supply of Bitcoin has created this idea that Bitcoin can be a potential hedge against inflation. It has been referred to as digital gold, due to the fact that it can be divisible, and that it is digital means that its circulation is much more fluid, it's much more accessible. The transactions of Bitcoin due to blockchain can happen much faster because it's not going through a central authority. There is much lower fees because there is no transaction fees that a bank might impose on you. There is no administration fees. the cost of transferring Bitcoin is much, much lower. However, this of course is not a guarantee, as it depends on the value of Bitcoin being maintained long term. And also, there is no true value of a Bitcoin outside of being traded, unlike gold, and so has been subject to these massive swings, as I pointed out earlier. And so, over time, new categories of cryptocurrencies have been developed, hoping to capture the success of Bitcoin. But none of them have captured Bitcoin's level of value, as Bitcoin currently sits at about 58% of the total market cap of all cryptocurrencies. But looking at the other cryptos that have been developed since then, you have your utility tokens and your user tokens, which are effectively digital assets that are on a blockchain, which can provide you with specific products or services within the network itself. This is cryptos such as Ethereum, Binance, Cardano. There are central bank digital currencies, which is a bit ironic considering the idea was built on this idea of being independent from central banks. It's effectively central banks wanting to implement blockchain technology, and currently the digital yuan is being developed, the digital euro project is in its early stages, and then finally there is stablecoins, which is a coin that is linked to a fiat currency or a stable asset. This has effectively meaning that the value of what if a stablecoin is linked to the dollar, then one stablecoin is worth $1, and that is how it is forever. It doesn't fluctuate on that in value independently, only on the exchange rate of that currency that it is pegged to. And so this has made it easier for cross-border remittances or for a more stable medium of exchange. And it removes the need of a conventional banking arrangement. So, now that we've talked about Bitcoin, now that we've talked about cryptocurrencies, now I want to actually take us to look at an alternative, because as I mentioned, it's not just Bitcoin. Bitcoin is massive and plays a major part in the crypto net space, but that's not everything. And so this is why I talk about Ethereum. Ethereum has been propped up as this Bitcoin alternative, but when you actually take a closer look at Ethereum and what you can do with it, you realize that it's not just the Bitcoin alternative, but is a new tech entirely. So a brief history of Ethereum. Ethereum was first proposed by a man called Vitalik Buterin due to what he perceived as the limitations that Bitcoin provided, specifically that it lacked the idea of these complex contracts and functions. And so as a result, he developed the Ethereum blockchain, in which the value of it isn't just that it is a medium of exchange, but that it allowed what were known as complex contracts, which were then expanded further to decentralized apps. What are complex contracts? Well, complex contracts are effectively system functions. They are codes that are if-then, meaning that if you input a certain amount of cryptocurrency, then I will do this, then I will do that. I will complete a service for you, I will transfer a right of ownership to you, I will be a valid medium of payment for your healthcare. This is what the dApp network is, and that is why it's known as a decentralized finance system. The Ethereum blockchain is its own economic network. So that is currently something that at the time Bitcoin just did not offer. Bitcoin was just value. It was just transacting Bitcoins from one person to another. But the interesting thing of looking at the history of Ethereum is that there were two moments that really showed how the whole philosophy of blockchain technology could change and could be acted against. The first was in 2016, in which an attack by a decentralized autonomous organization drained 3.6 million Ethereum coins through a flawed contract function. And so what was proposed was, in order to invalidate this transaction and to act as if this 3.6 theft never occurred was that the community voted and decided to then move onto another blockchain, to fork the blockchain in a different direction in a way so that that previous transaction never occurred. And so this changed from the immutable blockchain philosophy to show that you can actually have centralization in a blockchain, but that just requires a massive amount of social consensus. And the other was in 2022 when Ethereum transferred from a initial proof of work mechanism, as we talked about earlier, to proof of stake instead in order to reduce power consumption. So, how exactly does Ethereum differ structurally? If we're, say, looking at an Ethereum block, how does it function? Well, it's very similar to a Bitcoin block. However, Ethereum instead offers, due to the fact that there are these complex smart contracts and that there are these dApps on the network, there is something else that is implemented, and this is gas. There is start gas, which means there is the initial limit of computational steps of code executed by the validators. This is what is used in computation and the fulfillment of these smart contracts. And there is also gas price, which is your fee to the validator per computational work. These fees are then paid to the validators for their participation in order to discourage the network spamming. So effectively, in order for any of these smart contracts to be fulfilled, there is a fee that has to be paid just due to the computation required. And so all transactions for Ethereum transfers are placed inside of that mempool. And of course, the transaction with the highest value, which is the mixture of both its age and the total amount of Ethereum in the block, is proposed every 12 seconds. But in order to be a participant, you have to stake up to 32 Ethereum coins, or Ether. I should have introduced that term a bit earlier. And that is typically around about just less than $100,000. And only once these validators have confirmed the transaction is the block then amended to the Ethereum blockchain. So while Ethereum had been released in 2015, it had never, unfortunately, been as successful as Bitcoin. It too only reached a new high of nearly $5,000 back in April. However, they also suffered from a quite recent decrease in value, and now it's trading at about $3,300. But as I mentioned earlier, the value of Ethereum isn't coming just from its for its store of value, but rather due to its DeFi network. And as you can see, who has actually been using it? Well, VPNs have been accepting Ether as payment. The University of Utah hospitals accept Ethereum. UNICEF were able to fund some emerging economy startups through the Ethereum network. De Beers bought Tracer, which was a company that creates a digital double of diamonds. So you can record the quality of a diamond, such as its color, its carats, its cut, and effectively that is what is to help the. This is what helps and keeps the integrity of diamonds and transfers, so that you know that the diamond that you receive physically is the diamond that you purchased, due to the fact that you can compare it to this digital double. And just like Bitcoin, and finally, back in 2017, somebody was able to purchase an apartment in Kiev for 210 Ether. And so, just like Bitcoin, the value of Ethereum increased in value during COVID, and currently it is the largest DeFi platform. However, currently its share is about 63% of the total DeFi network. However, that value does decrease as new DeFi platforms are developed and released. And so, as I said, Ethereum and Bitcoin, they are not true rivals. Bitcoin is primarily a store of value. Ethereum has that DeFi network and smart contracts. And what's furthermore, Bitcoin, even though both rallied and both started in 2017, Bitcoin was the one who received much more of the benefit. And currently Bitcoin has a total market share of more than 50%, whereas Ethereum's is closer to 12%. This is primarily because Bitcoin has that greater security as a store of value, and the proof of work system, while it is much more costly through electricity, it is much harder to gain. Now, Bitcoin has tried to introduce this limited smart contract support, but as mentioned, it is limited. And currently Bitcoin still does not move to proof of stake due to this philosophy of an immutable blockchain, not wanting any changes to the blockchain, and also because some are worried that there may be a decrease in security due to transfer from proof of work to proof of stake. So, I hope that this gives you a clear idea of what Bitcoin is, what Ethereum is, what cryptocurrencies are, and why it is so appealing. However, as we have seen, because there has been such a massive increase in its total value in a very short amount of time, of course this is going to gain global attention, especially if you are acting against central banks. And so, how has the world responded to cryptocurrencies? Specifically, how have governments responded to cryptocurrencies? Well, not all of them are actually against crypto. In fact, governments themselves make up 3% of all Bitcoin ownership. While it is true that the significant share of this Bitcoin is coming from forfeiture, either criminal or civil, it is still being held long-term by governments. They're not just selling them off right now. And so, because it's being held in the long term, we don't know how that is going to change the fiscal demand and its market value. As we can see from the table on the left, the US government is the largest owner of Bitcoin. They own 1.5% of the world's share of Bitcoins. China is second at just less than 1%, followed by the United Kingdom, followed by Ukraine. And in fact, Germany used to be one of the largest holders of Bitcoin, but then had to sell them all back in 2024 in order to cover their debts. Now, some governments and countries are looking to hold and invest in Bitcoin alongside their other currencies and assets. El Salvador made Bitcoin a legal tender in 2021. Switzerland has proposed holding it alongside gold in their Swiss National Bank. Bhutan has a dedicated government-owned mining pool, which has accumulated 600 million in Bitcoin so far, which is the equivalent of 30% of their GDP. Abu Dhabi, their sovereign wealth fund, has invested into the BlackRock Bitcoin Trust, and Pakistan themselves are also looking at a strategic Bitcoin reserve. Now, I want to pause for a moment and take a closer look as to the United States. Earlier, I mentioned that the value of Bitcoin doubled in just a few days after Trump had won the election. So let's take a closer look at what he had proposed when he was talking about an American strategic Bitcoin reserve. Because while Trump had always flip-flopped on cryptocurrency, he had initially called it a scam, he has now fully embraced it. Bitcoin, of course, increased in value shortly after he won, but he had at the same time banned the development of the US creating a central bank digital currency. And so when he signed an executive order trying to create this strategic Bitcoin reserve, a digital Fort Knox, as he put it, he was looking at Bitcoin, the reserve of Bitcoin to be built up through civil forfeiture, through transfers, and through additional mining. there was also looking at storing non-Bitcoin cryptocurrencies, but only from confiscation. They were not actively pursuing other cryptos. The United States would be actively pursuing Bitcoin. Furthermore, with deregulation of cryptocurrencies and monitoring of illicit activity funded by cryptocurrencies, meaning that right now the US is much more friendly towards Bitcoin and crypto. But currently this strategic Bitcoin reserve has not reached the same scale as, say, its gold reserve, which is currently at 2. So meaning the Bitcoin reserve is only at 2.7% of the US's current gold reserve. So digital Fort Knox has not reached the same scale as actual Fort Knox. Earlier this year as well, the Genius Act was passed in order to regulate and define what US-linked stablecoins actually could be. This is very important considering that 99% of all stablecoins are linked to the US dollar. And of course, this limited the issuance of stablecoins to only permitted users, meaning that they have to be approved by the government, they have to meet state regulations, and they established an oversight system for stablecoin distribution. It also did require that all issuers of stablecoins must hold a 1-to-1 reserve. So for all of their stablecoins that they have distributed, they must have the same value in dollars in case anybody wants to redeem it. If any of you are wondering, well, how exactly do these stablecoin companies make money? They make it through investment. When you're suddenly sitting on a large amount of cash, well, there's no reason why you can't suddenly start purchasing government treasuries and government bonds, and also any company shares in order to increase your money passively that way. However, just because America has introduced this idea does not mean that it is popular. The Chicago Booth School of Business from the University of Chicago polled among 39 top economists, and there was a very strong sentiment of that holding these crypto assets is a bad idea. The majority of them disagreed with the idea that Bitcoin would have low risk. Most of them also disagreed with the idea that it is a good idea for the United States to also borrow money to purchase cryptocurrencies. And this primarily comes down to the fact that there is no linked value to cryptocurrencies that aren't stablecoins. They are volatile and they are speculative. And so who has been against it? Well, as I mentioned, the deregulatory nature of cryptocurrencies has drawn ire. It has been used as an exchange in organized crime. The volatile value of cryptocurrencies is perceived as dangerous, and also there is a large amount of capital outflow that a central bank or a government cannot control. And so, as a result, 7 of countries have so far made crypto illegal, and while most others have put prohibitions on banking and mining of crypto. And one of the largest banners and largest outspoken critics of cryptocurrencies is actually China, which is actually quite ironic if you remember that China is also the second largest government holder of Bitcoin. And so in 2017, the People's Bank of China banned the operation of crypto exchanges. In 2021, they banned all crypto transactions and mining in efforts to limit this crime and any economic instability. But if we're wondering, well, how is that possible, even with all of this regulation in place, if we take a look on the graph, we can see that despite these efforts, there is this total value of Chinese over-the-counter transactions currently going on in the past few years. So what has been going on here? Well, the problem with that is that despite the CCP's efforts, there is still a very wealthy underground trading in cryptocurrencies and P2P transfers due to the fact that investors and people are just worried about the Chinese economy depreciating at the moment. And when, as I mentioned, if you have countries that haven't made cryptocurrencies illegal, they have instead imposed restrictions on it. Egypt has prohibited any issuances, trading, or promotion. Turkey does not recognize it as a legal medium of exchange. Russia has banned the use for internal payments, but does allow for international trade and for mining. This is primarily a way to avoid the current sanctions imposed upon Russia due to the current Ukraine war going on. So that's how the world has responded to cryptocurrency. But how is South Africa specifically? Well, currently, the FSCA has declared crypto assets as financial products under FAIS in response to its growth and its growing interest. And so currently, looking at this table on the bottom, looking at this graph on the bottom left, South Africa is the second largest value holder of cryptocurrencies in sub-Saharan Africa. Last year, the value it had received was about $26 billion, but that is still less than half than Nigeria. Nigeria has been a massive adopter of cryptocurrencies. But as I also mentioned earlier, right now stablecoins have replaced Bitcoins as the most popular cryptocurrency in South Africa. But most crypto-related businesses currently are these small-sized financial service providers. Now, the FSCA has granted licensing powers to limited to only a certain number of CASPs, so crypto asset service providers, who are primarily providing financial services, so advice and intermediary and investment services. But currently, it is still not regulated. Crypto and Bitcoin are still not legal tender in South Africa. The Pretoria High Court has ruled crypto as not capital, and so CASPs, as a result, must adhere to fit and proper standards, as you'd expect. Now, as of December of last year, around 248 CASP licenses had been approved. And so right now there has been no approval for the listing of any crypto products on the JSE. Currently the idea of crypto ETF is not in the near future. This is primarily because regulation is actually looking externally. They are trying to see what the United States are going to say, what the UK are going to say, what Canada, Japan, Germany. They're looking they are looking externally for precedent when it comes to regulation. But of course, that hasn't stopped the adoption, as I'm sure some of you may have noticed. Currently, more and more merchants are accepting cryptocurrencies. Currently, cryptocurrency exchanges can support 55 different cryptocurrencies, but one in particular that has been gaining prominence, at least in South Africa, is Luno. Earlier this year, they introduced Luno Pay to start accepting cryptocurrencies as a medium of exchange, in which they reported that around 700,000 merchants had started accepting cryptocurrency as payment. These aren't just large purchases. These aren't just large sellers, because this is also including retail and restaurants. And if we look at the graph on the left, the total revenue that these crypto assets service providers are receiving isn't massive. Most of them occurring in the range of less than 1 to 50 million rand. Very few are receiving those massive transfers of cryptocurrencies. And now Luno have stated that the monthly average spending in crypto in South Africa has been around 2 million rand ever since November of last year. And so these are governments, but what about larger bodies? What are multilaterals saying about cryptocurrencies? Well, the International Monetary Fund, the IMF, they have looked and evaluated crypto and have found both pros and cons. Of course, cryptocurrencies offer the benefit of that they are cost efficient for sending remittances, the distributed ledger technology can reduce transaction costs, and there is also faster identification for any illicit transactions. It is much faster to find out where that money is going to. However, they are very concerned with what they call cryptoization, the fact that that is going to undermine monetary policy and erode the effectiveness of any capital flow measures or any monetary policy. Furthermore, crypto as a currency does not have a peg, meaning there is that much greater risk of volatility, and so it can have a very large impact on the monetary system. And furthermore, when actually looking at the correlation and value between cryptocurrencies, there is a much stronger correlation with crypto and equities rather than in safe assets such as bonds or the US dollar. Just looking at the line as seen on the line graph on the left. As a result, they believe, the IMF have said that cryptocurrencies are not suitable risk diversifiers, and instead have proposed that there needs to be some form of global arrangement and global coordination to create regulation in order to monitor the impact and also to maintain stability on the monetary system. The World Bank, however, have not been as optimistic, and they are certainly not very approving of the idea of using cryptocurrencies in foreign reserve portfolios. Usually FRPs are held for self-insurance purposes, but crypto itself might not be liquid enough to fulfill the function if not enough people actually sign on and there is not enough trading going on. Reserves typically should be long-term, have long-term value and be low risk. And so as a result, crypto is not a suitable enough diversifier. Just looking at these on the left, if we look at the change of value over time, Bitcoin in and of itself has increased value much, much more in the past 5 years than, say, gold or the S&P 500. And even just in this last year, if we take a closer look at it, Bitcoin has been trading in value much closer to S&P 500 rather than gold. But furthermore, the standard deviation of Bitcoin is also much, much greater, taking into account that greater volatility in price. So as a result, Bitcoin is not a suitable alternative to gold. And so now that we know all this, even though that there are all of these concerns, even though there are countries for crypto, and countries against crypto, it doesn't seem that crypto is going away, because at no point did either the IMF or the World Bank say the world should ban cryptocurrencies. And so if we like it or not, it seems that cryptocurrency is here to stay, but how is that going to affect the future? Well, if we start looking at crypto as an investment vehicle, as some companies have started to do, the first crypto-based ETF was started trading back in 2021, but this was a futures ETF. And as you can probably tell, and if there's one message you should be taking away from this talk, is that you cannot predict the value of cryptocurrencies. And as a result, ProShares Futures ETF has not performed as well as others. This is because your performance was depending on tracking that price. Now, then in 2021, a company called Purpose launched the first spot Bitcoin ETF. So with spot Bitcoin, they were directly tracking the price of Bitcoin. Now, since then, since 2021, their NAV has increased per unit by 100%. However, their company had always been limited to the Toronto Stock Exchange, which had experienced that mostly bearish Bitcoin market until 2024. That all changed back in January of last year, in which BlackRock launched their first spot Bitcoin ETF in the US market, with current assets under management of $71 billion, and having a total return of about 160% since its inception, so a short amount of time, creating a lot of value. And currently, BlackRock owns 560,000 Bitcoins. They are one of the largest owners of Bitcoin. And as a result, this allows for an indirect investment into Bitcoin. There's no need to get involved in buying and selling because you can have a one-to-one exposure of daily price performance. And so, as a result, there's been this growing trend of adding Bitcoins to portfolios in order to increase a company's value, at least on the spreadsheets. MicroStrategy, as I mentioned earlier, purchased a large amount of Bitcoin, 580,000, which increased their share price by over 400%. However, this doesn't always play out. As I mentioned as well, Tesla is the 12th largest owner by public company of Bitcoin, but their share price is still decreased by 15% due to the low sales earlier this year, and also the Musk-Trump fallout. We're only recovering in September. And of course, not all ETFs are the same, especially if looking at other crypto ETFs. Just as BlackRock introduced their Bitcoin spot ETF, they also introduced an Ethereum spot ETF. And just looking at the graph on the left, that Ethereum ETF in red has actually now had a lower value due to the decrease recently than when it was incepted, and compared to the Bitcoin ETF, which has still more than double the price it was during inception. And this is primarily because Ethereum has a much more complex framework and it does function differently. But Ethereum is also less volatile, as their value depends on technology and also the development of the DeFi network. However, even when it's not related to cryptocurrencies per se, the idea of tokenization and utilizing blockchain technologies for other functions has been increasing in popularity. Effectively, what tokenization is, it is a creation of a tangible asset into a digital representation, a digital doubling, which still has an economic value and a rights attached to it, which is put on that distributed record. This means that you can show proof of value and ownership through owning this token, and that is what has been turned into tokens. Has been fixed income and debt, public equities, real estate ownership, and of course NFTs. And so what the benefit of this has been that clear, tamper-resistant record and that reduction in transaction costs and admin burden. And so what we have been seeing in the past year has that been more and more companies have been considering tokenizing their bonds and governments tokenizing public debt. The US Futures Trading Commission now accepts tokenized bonds for collateral. Last year, the Hong Kong Monetary Authority issued $875 million worth in tokenized bonds. And as of August of last year, it was believed that there were currently about $1.5 billion worth of $1.5 billion worth of decentralized ledger tech bonds in global issuance. Now, if you can see on the pie chart on the left, the countries that have mostly been accepting of these DLT-based bonds, these have been growing in popularity, mostly in the Asian Pacific, as well as Switzerland. Europe has about 21% of the global share of DLT bonds. The US is only 10%, which is honestly a bit surprising. So it actually shows that Europe has actually been more open to the adoption of tokenization of bonds rather than America. And while the rest of the world just have not started utilizing this technology at all. And so, as I've mentioned, with such a massive increase in value and with so much volatility of these crypto assets, this has started people asking the question, well, are we now living in a crypto bubble? What is the basis of all of this money, and does it actually live up to its value that people are trading to? And so as a result, in order to analyze this, people have been drawing parallels between Bitcoin and cryptocurrencies and the dot-com bubble of the 1990s to 2002. Now, a quick reminder to people who might not have been born during the dot-com bubble or don't fully remember. The dot-com bubble was effectively, with the development of new infotech and the telecom sectors, an increase in access to the internet in people's homes. This led to a large increase in investment into digital companies, specifically those with dot-com sites registered to them. Venture capital companies started investing a lot of money into these companies, leading to very large IPOs. And as a result of it, in 1999, the NASDAQ rose by 86% and became 80% of the value of the entire New York Stock Exchange. And so suddenly, when it was announced that there was going to be a Japanese recession, as well as the expiration of lockup periods of initial investors, suddenly there was this reduction in optimism that was not expressed until it was too late, leading to a very quick, sudden decrease in value in all of these companies, and as a result, affected a number of these stock exchanges and indexes. And so as a result of this, the US Fed had to tighten their rates from 5.3% to 6.5%, so more than 1%. And so it took the NASDAQ 15 years to reach that peak of over $5,000 once again. And so the question is, as the Fed chair at the time, Alan Greenspan, said it, how do we know when irrational exuberance has unduly escalated asset values? So is the question, does this actually now apply to Bitcoin? And does this apply to cryptocurrencies? Well, as mentioned, the speculation of this crypto bubble has existed since the 2018 rally, with very prominent economists labeling it such as Krugman, Greenspan, Stiglitz, and Farmer. And this is due to it being critical towards that sudden rise in value with a lack of underlying asset. Now here's the interesting thing to know, is that, are we living in a bubble? Yes. There's no doubt about it. Cryptocurrency is a bit ridiculous when you think about it, and just look at it. You should have been thinking that this is rather silly, that suddenly something that really just doesn't really exist and you only have a right to has these massive increases in value. But the truth is that this bubble doesn't just exist, but it's already popped. In fact, it popped twice. It popped back in 2018 and it popped back in 2021, where it decreased by half of its value in the span of 2 months, and it decreased to just a quarter of its value within 1 year. But yet, crypto persists. People still have faith in it. People still invest money in it, and people still make money in it. And so, in order to try and quantify this, the Wharton School of Business have put together what is known as this Consumer Cryptocurrency Confidence Index. Effectively, they are sending out surveys in order to understand the sentiment towards Bitcoin and crypto at the time. This is effectively their equivalent of the University of Michigan's Consumer Sentiment Index, but specifically just related to Bitcoin. And so what they found is that there is a rising confidence in Bitcoin as that price increases. This is primarily makes sense because that supply curve is fixed, any price change depends on demand. But the thing is that the sentiment of crypto and the perception of crypto is actually split between those who use crypto and those who see it as a currency versus those who actually look at it as a long-term decentralized investment. And so nearly half of all crypto owners saw cryptocurrencies not as currencies as they're intended to be, but rather as these long-term investments, things to hold onto, things to sell when you get close to retirement and be comfortable with. Whereas people who are non-owners still see cryptocurrencies as currencies. So that's the thing. This confidence in this bubble exists until it does not. Bitcoin's price doubled in 1 month in 2024. But currently, as of the time of this recording, which is in December of 2025, its value is its increase year to date has only been 0.18%. So is there a bubble? Yes. But is it a sustainable bubble? Well, that's going to depend. And that's going to depend on Trump and his strategic Bitcoin reserve. It's going to depend on the marginal revenue versus the marginal cost of mining. And it's going to depend on the worldwide acceptance of cryptocurrency as currency. Now, before I end this presentation, I do want to quickly talk about one thing. As I said, I'm recording this video in December of 2025, and earlier this year, in August, the value of Bitcoin was at $120,000. Right now, it is sitting closer to $90,000 because in a very short amount of time, there has been another significant share of Bitcoin. And so people may be wondering, why is it that Bitcoin has suddenly lost its value? Well, because there have been multiple proposals have been introduced for this, multiple explanations. People have been linking it towards just a particularly bearish market, people wanting to capitalize on those gains that Bitcoin has made, and maybe people's confidence in Bitcoin has been decreasing. But the best explanation that has been proposed was due to the fact that the Bank of Japan last month announced that they were very likely to be increasing their interest rates in December of this year. And as a result of that increase in interest rates would affect the yen carry trade. Now, for those of you who don't know what the yen carry trade is, because the yen has very low interest rates currently, people have been taking out yen to then invest into higher risk products such as Bitcoin or such as corporate equity. As a result, hoping that the yields that they receive will outweigh the costs of those interest rates. And so when the Bank of Japan may be announcing that they'll be increasing those rates, suddenly you're going to have a lot of people withdrawing from their highest risk assets, which includes Bitcoin and cryptocurrencies. Furthermore, with a number of automatic put contracts put into place, that would lead to a significant sell-off. And so currently with Bitcoin trading around this $92,000, is this a pop in the bubble? Has somebody pointed out that the emperor has no clothes for the third time? Well, honestly, at this point, it's just too soon to say. So we will just have to keep on looking at it. It could mean that Bitcoin will decrease to where it was before 2024 to 50,000, or it could reach new highs as suddenly people are going to be buying the dip. We just don't know, and we're just going to have to wait and see. And so, in conclusion, Bitcoin has been built on 35 years worth of effort developing that potential digital currency, but it is the first one to be properly accepted and functional. And its appeal comes from its decentralized nature and its security in trade and ownership. Bitcoin's value is purely driven by demand, and its ability as a good investment depends on people's faith in that value. No other cryptocurrency has that same value, meaning that there is little risk in an alternative cryptocurrency suddenly being introduced and wiping away everything that Bitcoin has built. Ethereum is innovating in the DeFi landscape, but does not offer the same returns and has not gained as much attention. So we'll have to wait to see that. And so while there is skepticism and a push for increased regulation on crypto assets, the overall consensus is that crypto is here to stay and that there is some investment opportunity there. With greater adoption and implementation of blockchain and crypto alternatives still in its early phases. And then finally, yes, we are living in a crypto bubble, but it is a very durable bubble, with large surge coming from the support of Trump and the United States. And so his actions in the coming years will have a significant effect on its value. And it does raise the question of what is going to happen when his term is over. And now other countries are following suit, will likely strengthen its support and the validity of cryptocurrencies, and might actually make it be more viable in the long term.